Welcome to the Opening Bell Report.
We're looking at a setup today that, it highlights a really specific market dynamic. Imagine a situation for a second where you've got a stock that isn't just grinding through a standard recovery cycle. It's compressing.
Right, it's acting almost exactly like a coiled spring.
Exactly, like a coiled spring accumulating this intense, quiet pressure right at a key technical boundary. And the mission today is to unpack a new analysis report we have in front of us. It's titled Up 340% and Climbing. The technical setup for a Sellas breakout.
And that's Sellas Life Sciences.
Right, ticker symbol NASDAQ SLS. We are diving into a clinical stage biotech that has quietly engineered one of the most aggressive and honestly structurally sound rallies in the sector this year.
It really is a compelling piece of analysis because it maps out this situation where multiple market forces are just colliding.
Yeah.
In the biotech sector, you frequently see detached price action.
Oh, absolutely.
A stock might run entirely on retail momentum with just a terrible underlying chart. Or, on the flip side, you have a fundamentally strong pipeline that the market just completely ignores. But what the data points to here is a confluence of technical pressure, heavily skewed market positioning, and a very near-term fundamental catalyst.
All narrowing down to a single price level. To set the baseline for you, the headline metric here, the big reveal, is a 340% surge over the trailing 12 months.
And that 340% is notable not just for the raw percentage, but for the origin point. We're looking at a chart that successfully clawed its way out of the sub-dollar basement.
Yeah, that 52-week low sits at just 0.95 USD.
Right. And from that absolute capitulation point, the stock has systematically trended upward. It's been establishing higher lows all the way up to a recent close of 5.53 USD.
Including a very solid recent daily gain of 4.73%. So this isn't some flash-in-the-pan liquidity event where it spiked on a press release and then just faded the next day. The accumulation here has been incredibly steady.
Which brings us to the core premise of the analysis report. This 340% run isn't the terminal point of the move. The data actually frames this current 5.53 level as a critical technical launch pad.
Rather than the top of a distribution phase. Yeah.
Exactly. And that distinction between distribution and a real breakout setup is what makes the tape so fascinating right now. We are looking at specific conditions that, if validated by volume, could force a massive repricing.
Okay, let's unpack this, starting with a technical blueprint. The focal point of the analysis is that the current 5.53 price is sitting just underneath the 52-week high of 5.66 USD. It is tightly hugging that absolute resistance level.
That proximity to the 5.66 line is really the whole game from a charting perspective. When an equity approaches a 52-week high after a multi-100% run, it's testing a major historical barrier.
The ceiling.
The ceiling, yeah. The conventional wisdom is that you'll see a massive wave of profit-taking or aggressive short selling stepping in to defend that top. But what we're looking at here is a sustained challenge of that level. The analysis emphasizes that if Sellas breaks through 5.66 on heavy volume, it enters blue sky territory.
And for anyone who isn't staring at charts all day, blue sky territory basically means there's minimal historical resistance. There's no overhead supply of trapped buyers waiting to sell and push the price back down.
Right, the sky is clear.
But overhead supply at 5.66 is just one factor. If they manage to chew through the asks at 5.66, what's stopping the institutional shorts from simply stepping up, doubling down, and creating a new synthetic ceiling right at, say, $6 or 6.50 around? We see that all the time in momentum names. The shorts just absorb the retail buying power.
That is the critical question, and it's exactly why the underlying momentum metrics are so vital to this specific setup. If the stock had exhausted itself just getting to 5.66, then yes, a new short wall at $6 would likely crush the rally.
You just bounce off.
But if we look at the momentum indicators highlighted in the data, specifically the RSI, the relative strength index Sellas is currently sitting right around 67.5.
Which is an incredibly dangerous zone for anyone trying to build a short wall. Let's translate that RSI for a second. It's hot, but it has not crossed into that 70-plus overbought territory.
Exactly. That 70 line is where technical exhaustion usually triggers a mechanical pullback. An RSI of 67.5 right at the 52-week resistance indicates that the bullish momentum is aggressive and intact. But mathematically, the buyers still have room to run.
They haven't maxed out their leverage.
Right, they haven't maxed out their buying capacity. If the RSI were sitting at 85 or 90 going into this resistance test, you'd expect the breakout to fail. The buyers would be too stretched to absorb a new wave of short selling. But at 67.5, the buyers have the dry powder required to smash through 5.66.
And maintain the velocity needed to prevent a new ceiling from forming immediately above it. So the technicals are primed. But a chart setup like this doesn't exist in a vacuum. It interacts directly with the positioning of other market participants.
What's fascinating here is how that chart setup interacts with the short interest. The second major factor we're looking at is the raw positioning against the stock. The data shows that Sellas currently has 32.8% of its float sold short,
which translates to roughly 46.05 million shares sold short. I mean, let that sink in. That is a uniquely aggressive positioning considering the steady 340% climb we just discussed.
It's massive.
To maintain a 46 million share short position on a stock that is relentlessly trended up from under $1, that requires an immense amount of capital and risk tolerance.
It implies a deeply entrenched thesis from the short side. Look, a 32.8% short interest isn't just algorithmic day trading. That is structural institutional betting against the survival of the company.
And the risk metrics for a position of that size have to be brutal. As the price grinds from 0.95 up to 5.53, the mark-to-market losses on those 46 million shares are compounding daily.
Furthermore, the borrow fees on a stock with a third of its float shorted are typically exorbitant. The shorts are bleeding premium just to maintain their positions.
Which perfectly sets up the mechanics of the short squeeze the analysis report points to. If that 5.66 resistance breaks and the stock pushes into that blue sky territory, the risk desks at those short funds are going to start making phone calls.
That is the trigger. When an equity breaks a 52-week high with heavy short interest, the theoretical risk for the shorts becomes infinite. There is no historical resistance level above 5.66 to point to and say, hey, we can cover there.
Because there's no chart history up there.
Right. If the stock breaks out, the risk management protocols at these funds will force mechanical covering. They won't have a choice. They will have to step into the open market and buy back those 46 million shares at whatever the asking price is.
And if they are forced to buy into a market where the RSI indicates the retail and institutional bulls are already aggressively hitting the ask, get that classic feedback loop. The forced short covering acts as pure accelerant.
It creates a violent dislocation in the bid-ask spread. You have momentum buyers stepping in because the chart broke out, and you have massive institutional short positions panic buying to close out their risk. The available liquidity dries up instantly, and the price spikes.
It's like a powder keg.
It really is. Historically, in the biotech sector, when you see a short interest over 30% collide with a 52-week high breakout, the resulting squeeze can reprice the stock by multiples in a matter of days. We've seen similar setups in heavily shorted oncology plays where the squeeze forced a complete capitulation from the short side before the underlying fundamentals even fully materialized.
Here's where it gets really interesting, because the market doesn't just randomly force a 340% run on a 46 million share short position without a catalyst. A pure momentum squeeze on an empty shell company will collapse the moment the covering is done.
Absolutely.
To sustain a move like this and to get the technicals and the short interest wound this tight, there has to be a fundamental valuation anchor. We need to transition to the fundamentals.
Because a technical breakout needs a fundamental narrative to sustain it. It's not just lines on a chart. And for Sellas, that narrative is entirely focused on the upcoming Phase 3 Regal trial data for their lead candidate. That's Galenpepimut-S, or GPS for short.
The analysis makes it very clear that the market is aggressively pricing in the probability of a successful readout. And in the clinical stage oncology space, a Phase 3 readout is the ultimate binary event.
It is the defining moment for the asset's valuation model. The data will either validate the commercial viability of GPS, potentially unlocking massive market share in the oncology space, or it will fail to meet the endpoints, which would severely impair the company's valuation.
It's make or break.
It is. The steady accumulation from 0.95 to 5.53 tells us that the smart money, the institutional flows, are increasingly positioning for a positive outcome. They are absorbing the short selling because their modeling suggests the Phase 3 data will be a clear win.
But there is a massive structural trap that usually catches these biotech rallies. Typically, when a clinical stage biotech company sees its equity run up a few 100% ahead of data, the management team instantly hits the ATM, the at-the-market offering.
Right, they dilute.
They dilute the float to raise the cash they need to actually commercialize the drug, or just to fund operations in case the trial fails.
This is the standard operating procedure for the sector. Management teams use the retail and momentum liquidity to clean up their balance sheets. But that floods the market with new supply, it kills the technical breakout, and essentially bails out the short sellers. The shorts actually rely on that exact dilution to save their positions.
But the data highlights this cash runway anomaly with Sellas. They engineered a completely different capitalization strategy, and it changes the entire dynamic of the trade. Instead of a dilutive public offering that would have crushed the momentum, Sellas secured over 54.6 million USD via immediate warrant exercises.
That is a highly sophisticated corporate finance maneuver, and it sends a massive signal to the broader market. By incentivizing their institutional backers to exercise existing warrants early, Sellas brought $54.6 million in hard cash directly onto their balance sheet without expanding the fully diluted share count beyond what was already modeled.
The implication of those warrant holders agreeing to exercise early is huge. Think about it. They didn't wait for the data. They willingly handed over $54 million right now, ahead of the binary event.
Exactly. It completely de-risks the company's cash runway through the phase 3 readout and well beyond. The financial buffer is secured. And strategically, it removes the dilution overhang that the short sellers were absolutely counting on.
And so the shorts are just stuck.
They can no longer sit back and wait for a secondary offering to provide the liquidity they need to cover their 46 million shares. The company just doesn't need to raise cash.
That absolutely traps them. It removes their fundamental thesis for staying short. If the company is fully funded and the technicals are breaking out and the phase 3 data is looming, the shorts are left stranded.
It also provides a foundation for the analyst community to aggressively rate the stock. The analysis report points out that the consensus among covering Wall Street analysts is a unified 100% strong buy rating.
Which is incredibly rare for a pre-data clinical biotech.
Yeah.
Usually you see a mix of holds or cautious buys because the risk models are so heavily weighted toward the binary outcome. A 100% strong buy consensus indicates that the analysts believe the risk-reward ratio is heavily skewed to the upside, even after a 340% run.
And we have to look at their price targets. The high-end targets highlighted in the data are pointing to 7.88 USD. With the current price hovering around 5.53, the institutional models are projecting significant upside strictly based on the fundamentals and the de-risked balance sheet.
If the fundamental valuation is anchoring near $8 and the technical chart is threatening a breakout at 5.66, you can see exactly why the pressure is building. The institutional money is looking at a discount to fair value, the momentum traders are looking at a blue sky chart setup, and the short sellers are staring at 46 million borrowed shares with zero fundamental bailout in sight.
It's a textbook setup, a perfect convergence. The technical setup is merely the mechanism. The fundamental reality of the fully funded balance sheet and the impending clinical data is the fuel.
So what does this all mean? If we summarize the core takeaway from the analysis report, synthesizing the technical resistance, the massive short interest, the phase 3 catalyst, and the brilliant warrant strategy, the verdict here is that Sellas is not a traditional value play.
Not at all.
This is a high-octane, binary event biotech trade, the perfect storm, a combination of massive short interest, a well-funded balance sheet, and a chart testing its 52-week high.
And the parameters for traders are extremely clear. For the market to confirm this setup, the bulls need to deliver a specific signal. Touching 5.66 intraday and getting rejected is just noise. The absolute key signal, the moment the market acknowledges the breakout and the squeeze mechanics truly engage, is a high-volume daily close above that 5.66 level.
It has to close in the blue sky. The volume has to be there to prove that institutional buyers absorbed whatever final supply the shorts could throw at them and close the book for the day in new territory. Once that happens, the mathematics for the short sellers completely break down.
It's game over for them at that point.
Before we wrap this up, I want to leave you with a final provocative thought to mull over on your own. We spent a lot of time analyzing the charts, the 340% climb, the RSI, and the 54 million in cash. But take a moment to consider the sheer psychological weight sitting on the other side of this trade.
Oh, the pressure has to be immense.
Imagine managing a risk desk, holding a massive chunk of those 46 million shorted shares. You shorted this stock, assuming it would dilute or fail its trials. Instead, management outmaneuvered you with a warrant exercise. The stock has relentlessly marched up 340%, and now it is sitting pennies away from a major technical breakout line. Every single day that the phase 3 Regal trial data inches closer, the pressure compounds.
It's a ticking clock.
It really is an incredibly intense, high-stakes game of chicken between the clinical timeline and the technical chart. Do the shorts capitulate and spark the 5.66 breakout themselves, or they hold into the data, risking absolute structural devastation if the readout is positive? It's a masterclass in market psychology playing out right now in real time. Thanks for joining us on the deep dive. We'll be keeping a close eye on the tape.
Don't forget to like, share, and subscribe for more.